Once upon a time, there was no easy, affordable way for investors to own a broad, diversified index like the S&P 500. Individual stocks were volatile and came with expensive commissions, while actively managed mutual funds promised diversification but underperformed the market and charged high fees for the privilege. Then in 1976, the low-cost passive index mutual fund was born, and there was much rejoicing. For years, low-cost index funds produced better returns than their active competition, minus much of the turnover, taxes, and fees. But there was one big flaw weighing down traditional index funds: their market capitalization-weighted structure. By weighting their holdings according to market cap, traditional index funds were systematically forced to overweight the most popular and often the most overpriced stocks, and at the same time underweight the least popular and often the most underpriced. This buy high, sell low approach created a major drag on returns. By the late 90s, when the dot-com bubble sent tech stocks soaring to ridiculous heights, market cap weighting had become downright dangerous. Because the more overpriced internet darlings like Cisco and AOL became, the more index funds were forced to overweight them, until it all came crashing down. In 2002, Rob Arnott and Jason Su founded Research Affiliates because they believed there had to be a better way to invest. With an intuition that market mispricing was hurting investors, Rob, Jason, and their team examined alternative indexing strategies, where portfolio weights were not based on market cap. And they were shocked by the results. Nearly every approach they came up with easily outperformed the cap-weighted market, by an average of 2% per year. How did these simple strategies do what so many active mutual funds could not? The secret to every benchmark-beating approach was that it ignored market cap and the noise of inefficient market prices when weighting the portfolio. So instead of piling into stock market favorites, each year these alternate approaches were systematically underweighting overpriced stocks, overweighting cheap stocks, and ignoring trendy investment fads that sucked active managers in like moths to a flame. But every weighting strategy had its weaknesses. So after several years of careful research, Rob, Jason, and their team launched a better solution: the RAFI Fundamental Index. Instead of weighting based on market cap, the Fundamental Index weights each firm using a combination of core metrics, such as sales, cash flow, book value, and dividends. The result is a portfolio that weights firms by their size in the economy, not their stock market popularity. If a company grows faster than its stock price, the fundamental index overweights it relative to the benchmark. If a company's stock price gets ahead of its fundamental size, the fundamental index underweights it. By mirroring the macroeconomy instead of the inefficient stock market, research shows that the RAFI Fundamental Index can add, on average, 1.5% to 2% per year to S&P 500 performance. And it does so while preserving many of the benefits of a traditional index: low cost, low turnover, high capacity, highly liquid exposure to the most profitable companies in all sectors of the economy. And it's no longer just research. In 10 years of actual investing, RAFI Fundamental Index strategies have produced solid outperformance across every kind of market. In booms and busts, periods of large and small cap leadership, value and growth outperformance. And the RAFI Fundamental Index doesn't just work for large cap US stocks. The Fundamental Index approach can also add long-term value in many other markets, including small caps, international developed, and emerging markets. To learn how RAFI Fundamental Index strategies can help you meet your financial goals, contact your advisor today. And may your returns live happily ever after.